with the overview. And first of all, I've just started with showing a bit of our track record over the last 10 years. And I think Hyprop has done quite well in delivering good investment returns to our shareholders. If we look there at the distribution growth of 11.7% per year over the last 10 years, and then for a fund that normally just focus on or mainly focus on income growth, we've also been able to get good NAV per unit growth of 20.4%. But if you look there on the right-hand side, those are our main key focus areas. We look at sustainable income growth. We invest in high-quality shopping centres, not only anymore in South Africa, but into the rest of Africa as well. We keep to the same strategy there. We've got specialised and experienced internal management in the company. And also the company's got a very strong balance sheet to do future growth. If I can briefly look at the financial highlights for this year, I'll just touch on these points. Lawrence will go into more detail and give a better or a more detailed explanation to the numbers. Our year-on-year growth came in at 11.3%. That's a little bit higher than our guidance we put out at our half-year results. I think the number there was 10.5%. We did see very good growth coming through in the second half of this year, and we recorded there 13.1% increase. Also, our NAV now stands at around about 76 Rand, also grew nicely at 11.1%, while we saw very good growth in our total property assets by 17.3% to 26.4 billion. That's mainly due to investment and development activities, as well as increases in revaluations coming through. Our gearing now stands at 28.4%. That's much closer to our target, as we've been communicated to the market before, that ideally we'll be happy with a gearing ratio of between 30 and 35%. And then despite the increase in our direct portfolio, we've been able to keep a control on our tenant arrears, and that number has come down to 14.3 million. If you can look at some of the activities during the year, many of these activities occurred in the first half of our financial year, and I have reported on it before in quite detail, so I'm not going to go through it again. But just in terms of acquisitions, we took transfer of Somerset Mall in October last year. We acquired African Land with Manda Hill Shopping Centre as its only asset in December last year. And during the year, our investment in Atterbury Africa also increased to 812 million, and that's due to developments taking place in that portfolio. We also, around about December, January, we exited SciComm and we sold our stake in Mantra Blocks. That means we don't have any indirect investments anymore. And we used that proceeds of 205 million to refinance some of our other activities in the company. We also made a decision now that those assets that we currently don't see as our core assets anymore, to move it in our balance sheet to the held for sale line. And those assets are made of our freestanding office parks in Pretoria, Stoneridge, Willowbridge, Cape Gate Lifestyle. And we are looking to sell or dispose of those assets in the future. We also, as we announced previously, we did restructure African Land from the 1st of July of 2014. Then looking at major developments, three major projects currently under construction. The big one for us there locally has been Rosebank Mall. It's been a 2-year project, and it's now reaching its final completion with the opening of the Woolworths store at the end of September. So we've got about 4 weeks to go before that becomes operational. Our cost and yield is still the same as we reported before. The centre, at the centre, all the space are now fully committed, and there will be a couple of shops that will open after September. But so far it's gone exceptionally well. We had many of our new stores opening from the 1st of July. In the garden site, and that includes tenants that wasn't in Rosebank before, like Edgar's and Dis-Chem. Then the other projects are in Atterbury, Africa, and Kevin will give us a bit more detail there. But just to summarize, Westhills will open in about 8 weeks' time. That will be the biggest mall in Ghana. That was also about a 2-year project. And then Achimota Mall, we started with construction there in June, and that's due for completion October next year. Just some of the other focus areas for us in the company as well. We're looking at energy initiatives and where we can save, especially with the rising cost of electricity, and that seems to go up all the time. Our project for the year was to replace all the lamps in our mall areas throughout the portfolio. And as you can see there, I'm not going to go through all the numbers there, but we've been able to record some nice savings. We're also now participating in a carbon disclosure project in GRESP, and that will also enable us to benchmark us against our peers. One of the projects we're looking to do in the next financial year is we're busy with the installation of a solar plant at Clearwater Mall. It is a test project for us, and if that's successful and it can operate successfully for us, we'll look at to do that elsewhere in the portfolio as well. And also to manage our energy consumption better at our malls, we're starting with the introduction of smart metering. Then on a consumer side, we always look at ways of connecting to our consumers in better ways. And to that extent, our marketing teams are working quite hard all the time to be active on all the platforms that our consumers use. You can see the numbers there for Facebook, website hits. Also a very nice project that we're busy rolling out throughout the portfolio, and it should work at all our centres by year end, is the high-speed Wi-Fi availability to our customers. And then we're also rolling out just gift cards at some of our shopping centres that hasn't got gift card opportunities at this point in time. Then just look briefly at our company structure. We always try to keep it as simple and as transparent as possible and to make it easy for investors to understand. If you look at the South African portfolio, you can see there that's the whole portfolio, all the properties we have. And you can see how we've classified, especially now the held for sale within a South African structure. And then we're basically following the same principle with our restructuring of African land now. And we've got now one investment vehicle. It's a company set up in Mauritius that holds all the shares in our investments in the rest of Africa. Then just to give you an overview of how the company has changed over the last 3 years, not only have we been able to grow our asset base quite significantly, but you can also see how we're shifting our focus. And you can see over time we've traded out of the listed property securities. You can see how our investments in Africa has grown, and now at this point in time we can see Sub-Saharan Africa investment stands at 2.2 billion. Our held for sale portfolio is about 1.7 billion, and then our core South African portfolio is at 22.5 billion rand. Then next, just briefly looking at operating performance in our South African portfolio in the financial year. We've been able across the board to produce some good strong operating performances. If I can start there at the top, 9.5% like-for-like growth in our regional large and super regional malls. Those exclude Rosebank, obviously has been under development, and Somerset we didn't have for the full financial year in our numbers. We've also been able to maintain a very good occupancy rate at 97.6%. We've contained our property expenses to a cost-to-income ratio of 34.4%. I think that's marginally lower than the previous year. And as I said before, we've been able to control our rental arrears as well. Then looking at the trading indicators, and what I've done here, I showed for the last 4 years. I think the nice number there is how we can see the vacancies have declined over the last 4 years, while we've been able to hold our trading density growth in a portfolio at 7%, and our rent ratio has also been very stable in a portfolio over the last 4 years. The vacancies in our core portfolio, being our shopping malls, still remains extremely low with a good demand for space. Overall, in the retail portfolio, it stands at 1.2%. During the year, we did see some significant reductions at vacancies at the value centres. Our offices took a bit of a dip towards the financial year end, where we ended up at 13.8%. But subsequent to that, we've done some good letting, especially in the Pretoria office parks, and we've been able to reduce that number down to 9.5%. The office income is not a big part of our total income. I think it's around about the 2%, and in terms of GLA, it's only 5% of our portfolio. Then looking at leasing terms, again, we were able to improve year on year in our both rental growth and contractual escalation, and it's quite pleasing to see that we're able to maintain it above the 8%. You can see our rental growth has been the best it has been over the last 4 years, while we've been able to maintain very good contractual escalations. Look at the detail, the split between retail, offices, as well as new lettings and renewals. It's fairly evenly spread across the whole portfolio. And even despite the higher vacancy levels in offices, we are still able to record good rental growth and contractual escalation. Total lease activity for the year was around about 135,000 square meters, and that's about nearly 17% of the portfolio. So it wasn't that extremely high. However, looking at the next financial year, we can see there's going to be quite a significant increase in our workload. At this year, we're looking at 200,000 square meters. That's 25% of the portfolio. And if you can see where the main areas are, it's at Cape Gate, Clearwater, and the Glen. But it also gives us an opportunity then. Some of those opportunities include that we want to replace underperforming tenants in those malls, especially at the Glen and Clearwater. We want to do some work there, and the underperforming tenants have been affecting the trading densities at both those malls. Also gives us the opportunity to introduce nice, exciting brands that's coming to South Africa. We did the first River Island in South Africa that opened recently at Rosebank Mall. As well, in 2 weeks' time, we'll open the first Forever 21 in Canal Walk. Then we're continuously working closely with our national tenants to look at possible enlargement of their stores, where they've got a more demand for space, or to upgrade their stores in order to retain their flagship status in our portfolio. Then just the rest of our developments, the smaller developments. I've already covered the bigger developments earlier. The focus there, as I also was chatting to some of the guys before the presentation, is to continuously improve our existing portfolio and to focus on our core portfolio and to differentiate ourselves there. We also have an ongoing equipment replacement program, and for this year we spent 28 million rand, and that enables us to keep our maintenance costs low and also introduce new technology which makes it more energy efficient. A number of projects that we're looking at the moment. A couple of extensions we are planning, and we're looking to spend approximately 150 million rand in the next financial year. And there you can see a list of some of the smaller projects that's going to be completed in the next couple of months. Quite an exciting one there for us is Hyde Park, where we've relocated Dion Wyatt to the ex-CNA space, and that old Dion Wyatt space we're busy refurbishing and refitting out for various high-end tenants. And here you can see kind of look and feel we want to introduce there at Hyde Park. And we continuously have good demand for shops from high-end retailers. That's all for me at this point in time. I'm going to ask Kevin now to take over from me and to talk about the rest of Africa.
Thanks, Peter. What I've done is we've put a couple of slides together just to sort of give you a background of what's happening in Africa, in our two markets as well, Ghana and Zambia. and then give you a sort of snapshot about our restructuring and also about our portfolio in those two markets. I'm going to run through 5 or 6 slides. Apparently, it's a percentage of the portfolio size, so we're still underneath 10%. So hopefully, in the next results presentation, we'll have more slides. So how's Africa stacking up? I mean, it's amazing the fact that it's been 7 years since we had the financial crisis in Europe, and we've been in a market where the developed world has been growing at a single digit, so 1 to 2%. We're seeing in Europe, for example, France is struggling to get beyond 0%, and even Germany as well is facing pretty much slow growth. And then in South Africa, we sort of borderline, sort of 1 to 2%. When we look at the continent, sub-Saharan Africa, we're seeing still strong growth of around 4 to 5%, despite the fact that we've got a couple of headwinds in Africa. One is security risk. In key markets, for example, in West Africa and East Africa, you've got terrorism risk that's been ongoing for the last year or so. And then also, during the course of this year as well, 3 or 4 countries have been hit by the Ebola virus as well. So those are headwinds for the continent. But having said that, I think if you look in a nutshell, it's still growing healthily. Our 2 markets, Ghana and Zambia. Ghana, again, good performance growth, despite the fact that since the beginning of the year, the overall economy has been struggling, or rather the government has been struggling from a fiscal perspective. And the good news is the government have actually gone ahead with the IMF to restructure the current debt that they've been overlaying over the last year or so. But again, still positive growth around 6 to 5%. We've seen also increasing pressure over the last couple of months on the cedi. The cedi was 1 to 1 in 2008, moved to 2.5 to 2.5 to the dollar in 2013, and lately it's sort of struggling between 3.5 to 4 to the dollar. Hopefully, with the IMF restructuring, we're going to see a clawback on the value of the cedi. In terms of Zambia, again, it's doing extremely well. We've seen the government, they've gone back to the market early during the course of the year. They've raised $750 million oversubscribed. The yield is trading around 6.5, which is pretty good. And we're seeing a lot of that money is being invested in infrastructure. So if you go to Lusaka, it's quite amazing to see the number of roads currently being built, so which is good. It's something which has been lacking for the last decade. It's interesting that this slide, there's a report that's been put together by Standard Bank, which I think is quite revealing. It's the first time that we've seen a report where basically you look at the population of households in Africa and also the underlying middle class growth. So if you look at 2014 to 2030, there's going to be a significant increase in your middle class, your sort of middle to upper middle class. And the top 2 are really what the people we're sort of targeting in our malls as well. Moving next, our 2 markets, I think it's important as well to show you where our 2 markets are stacking up compared to other countries as well. So on the left axis, basically you're seeing the percentage of middle-class households as a share of the total households. So if you look at Zambia and Ghana, even though they're sort of smaller economies to other countries, they still have a decent size of middle class, which is around 20%. And Nigeria, obviously, as well, sort of beyond 20%. From a yield perspective, I think I wanted to share that with you. It's interesting. I've been on the continent for almost a decade now, and it's interesting to see that over the last couple of years, we're seeing compression of yields. I remember back in 2005, everything was for a 5-year payback. So you're talking about yields of 12 to 14%. And the last 2 years, we've seen significant compression. And this year, we're even seeing, amazingly, in key markets like Nairobi or East Africa, and even Nigeria as well, people are talking about yields of 7 to 7.5%. A year ago, when we were fundraising, investors in those markets were talking about 8.5% to 9%. And I think there are a couple of reasons as to why that's happening. I think we're seeing more and more investors scouting for deals, so it's quite a lot of money looking for assets. The reality, there are very few A-grade good assets to be bought. So the example Accra Mall. If you were to go to Ghana, there's only one mall to be bought. It's Accra Mall. Same thing as well in Zambia, in Lusaka, like Mandy Hill, it's the biggest mall and it's probably the best mall in town. So a lot of money chasing very few stuff on the ground, basically. And the liquidity is coming from South Africa, obviously. And then also we're seeing increasing international investors scouting for deals. And then also in key markets like East Africa, we're seeing local money chasing local products as well. The other thing that we're seeing as well is increasing demand from retailers to expand across the border. So we're seeing more South African retailers going further up north. In addition, we're seeing international retailers as well coming down south. So the brands that we're talking about are the Debenhams, the Carrefour, for example. Carrefour have signed their first 2 leases in East Africa, and they're looking at signing other leases as well in West Africa. So that's really happening, that sort of blend between South African brands and international brands as well. So hopefully in a year or 2, we might have River Island as well. From a debt funding point of view, there are not many banks out there who are willing to lend. There are probably 2 or 3 compared to 1 2 years ago. But we're getting the ability to raise longer-term funding. So a couple of years ago, you could raise probably around 5-year money. Now we are able to raise 7 to 8-year money. The other thing which is worth noting as well is land costs. Obviously, because we've got a strategy where we're going to be investing in developments as well. In certain markets, we're seeing land costs increasing quite significantly. Used to be around 5 to 10% of your total development costs. In key markets like Lagos or even Nairobi or Kampala, land cost is accounting around 15 to 20%. It's just a scarcity of decent, sizable land in good location. The structure, a lot has happened over the last 9 months, or rather 6 months. So the 2 structures, Atterbury Africa, that's been ongoing for the last 2 years, and African Land for the last 9 months, are being merged, or have been merged basically into one entity and being rebranded as At Africa. The strategy for us for this year, for this financial year, is to consolidate the At Africa team. So you've got the African Land team and the Atterbury African team as well. So we're going to be basically a team of 8. Also, our strategy is to manage internally as well. So the asset management is going to be done internally with the assistance of our colleagues of Atterbury for the next 12 to 18 months, just ensuring that we've got all the processes, the skill set as well. And then the key one as well for us this year is the opening of West Hills. So this is happening on the 30th of October, so in a month and a half now. And that's sort of interesting because it's going to be the biggest mall in Accra. And then from a development perspective, we've got Achimota and Kumasi City Mall that are currently being built. Achimota will be delivered by October next year, and Kumasi would be the following year, 2016. And then our last point is basically we're going to spend the next 12 months identifying key countries we want to be in and building our pipeline as well for the next 3 years. Just to give you a bit of insight about our current portfolio, Accra Mall, it's the only mall in Ghana, 19,000 squares. The latest valuation is $82.5 million, so $4,500 per square meter. It's fully let. There isn't a week that we're getting sort of inquiries from tenants for Accra Mall, and that's why we're looking forward to the expansion, which is being planned to sort of ramp it up from 19 to 39,000 squares. The interesting stat is the number of visitors. Despite the fact that Ghanaian economy hasn't been doing that well compared to the last 5 years, we're seeing good foot traffic. So we've got around 3 million visitors over the last 6 months, 100,000 Facebook fans. It's sort of interesting. This is one mall compared to the Hyprop's portfolio. So it's a third of Hyprop's portfolio. So people are connected in Africa, that's for sure. From a leasing perspective, strong demand from existing tenants. So from a renewal perspective, we're not worried. They're going to renew their leases. And then also we're seeing a new breed of tenants as well. So it gives us the ability to rejig the tenant mix as well going forward. Moving on to Manda Hill, we bought Manda Hill 9 months ago. It's the biggest mall in Lusaka. It's 43,500 squares. Latest valuation, which was done 2 months ago, is $153 million US, so $3.5 US per square meter. Again, fully let. We keep getting inquiries as well for Manda Hill, and hence the reason why we're looking at potentially expanding by an additional 10,000 squares. It's interesting as well, the trading density has been up by 7% in US dollar. And that's despite the fact that the kwacha over the last 6 months moved from 5.5 to the dollar to 7, though it's sort of clawed back to 6.1 over the last couple of weeks. In terms of what we've got in our portfolio from a development point of view, West Hill, which is going to be open, we're opening phase 1, which is 27,500 squares. It's 99% let. We're opening on the 30th of October. And also we've got plans to expand by an additional 12,000 squares. At Chimota Mall, which is in Accra, north of Accra Mall, it's around 6 km north of Accra Mall, 13,500 squares. The construction is well on track and for completion October 2015. And in Kumasi, just to give you sort of a difference or similarities between Kumasi, it's the second biggest city in Ghana. It's around 4 hours drive from Accra, 1 hour flight from Accra. 2.5 million people in Kumasi versus 4.5 in Accra. So Kumasi Mall is going to be 27,000 squares, anchored by ShopRite and Game. We've just started construction, and it should be delivered by end of 2016. That's it for me. I'm going to pass them to Lawrence.
A good set of results. Distribution growth of 11.3%, slightly exceeding guidance. Distribution growth for the half year was 13.1%. We had strong growth from the core shopping centre portfolio, with average growth of 11% from the Glen, Clearwater, and Woodlands. We also benefited from savings in interest costs, partly due to disposals of 205 million rand in December, as well as the fact that the debt raised to acquire the stake in African Land was left floating, pending a restructure of that investment. Disposals were 139 million, relating to a 20% stake in Garden Route Mall, and 66 million relating to the last remaining units in SAICOM. The year-on-year dilution from Rosebank Mall was 16.1 million. Just to put the loss of income from Rosebank Mall in perspective, in 2011, which was the last full year of income prior to beginning the redevelopment, we earned net income of 70 million from Rosebank Mall. This year, we earned 33 million, a decline in absolute terms of some 37 million, or 53% over 3 years. None of the loss of income was capitalized, so fortunately, the portfolio is now large enough to absorb the dilution. The 2.2 billion invested in Africa is made up of 800 million in Atterbury, Africa, and 1.4 billion being Hyprop's 87% share in Manda Hill in Zambia. This slide unpacks the growth in distributable earnings for the year to June. The majority of the growth came from the existing portfolio, the first black bar. The loss of income from SAICOM over here is offset by the contribution from Somerset Mall. The contribution from Africa, although still small, will likely grow over time. This reflects the income statement in a distributable earnings format, having taken out the IFRS adjustments. Investment property income and property expenses are not like for like due to the inclusion of Somerset Mall from October last year, hence the 16% and 17% increase respectively. Income from African Land represents income from Manda Hill for 7 months from December last year to June this year. You can see the gearing effect coming through here with net income before interest at 9.2%, after interest 11.3%. The number of combined units in issue increased slightly due to a small number of units issued during the year for the acquisition of African land. Net income from the South African shopping centre portfolio is now 93% of total net income, in line with our strategy of focusing on prime quality shopping centres. There has been a gradual reduction in the share of net income from standalone offices, a trend which will likely continue in the years ahead. Total assets on the balance sheet now up to just under 27 billion. Since we consolidate African land, investment property on the face of the balance sheet includes 100% of Manda Hill. The 1.4 billion I referred to earlier represents our 87% effective share. The investment in Atterbury Africa comprises mainly our effective interest in Accra Mall, acquired by Atterbury Africa in 2012, and West Hills Mall, also in Ghana, scheduled to open in October. Held for sale in the prior year relates to the investment in SACOM, while the 1.7 billion in the current year comprises Willowbridge, Stoneridge, Cape Gate Lifestyle, and the 3 standalone office parks in Pretoria. NAV per unit was up 11%, mainly due to an increase in the independent valuation of the property portfolio. "100% of the property portfolio is valued by independent valuers on a 6-monthly basis. In the valuations table, super regional relates to Canal Walk only, while regional is Hyde Park Corner only. Note that the percentage change is year on year from June last year to June this year. The large change in large regional and in total is due to the inclusion of Somerset Mall. Excluding the effect of the acquisition of Somerset Mall, year-on-year growth was 8%, while for the 6 months from December to June, the portfolio value grew by 5%. The most demanding yield in the portfolio is Canal Walk at 6.7%, while the large regional and regional malls are valued at just above 7%, closer to the portfolio average. Net borrowings and the gearing percentage were up year on year, mainly due to capital expenditure on Rosebank Mall, developments in Atterbury Africa, and the acquisition of African land. Fixed rate debt at 71% of total debt is below sector average, but will increase to around 80% post-year end when we fix the US dollar funding for African land. The African land funding will be fixed for a minimum of 5 years, which should increase the average fixed maturity profile closer to an average 5 years. Existing bank facilities amounting to 900 million will mature in the next 12 months, which will present an opportunity to increase the average debt maturity. There is good appetite for high-quality debt, and Hyprop has benefited from strong demand for its corporate bonds and short-term commercial paper. We will consider both conventional bank funding and debt capital market funding as potential avenues for refinancing, with a focus on pricing to reduce the overall cost of funding and tenor to increase the average maturity. DCM funding has assisted in diversifying our sources of funding and increased the ratio of unsecured debt on the balance sheet. The percentage of total debt in DCM, currently at 32%, will increase in the coming year, will likely increase in the coming year as existing bank maturities mature. The most notable change evident from this slide is the increase in dollar funding, mainly due to developments in Atterbury, Africa, and the acquisition of African land. There has also been approximately 650 million increase in DCM funding year on year. 450 million rand of that amount was a 6-year bond that was issued in October last year. The overall cost of funding has reduced, mainly as a result of a large amount of dollar funding, which is at cheaper rates. New rand-denominated swaps and fixes are anywhere between 80 to 150 basis points more expensive than current levels, so the continued introduction of dollar funding should benefit the overall cost of debt. This concludes the financial section. Peter will now complete with prospects. Thank you.
Looking at prospects and some of the risks, it's not all plain sailing. We also have some issues that we have to deal with. I think some of the issues facing our industry at the moment, slow economic growth, I think that affects everybody in South Africa. It is a concern. It is very difficult to grow your business and to acquire assets in this kind of environment. And in addition to that, we are seeing more developments coming to the market, shopping centre developments. So the market, in our opinion, at this point in time is quite mature. It does put more pressure on us to perform. And also we need, and therefore one of the reasons for why we continuing focusing more and more on our own shopping centres is to differentiate ourselves from the competition. Lately we have seen some distressed tenants in our market. I think it's mainly due to not being well managed in most instances when we look at those businesses. Also, I think all the strikes we had in the first half of this year did add to their problems as well. So far we haven't been affected significantly, but it is something that we're always concerned of and we have to keep our eyes open. And then another issue for us that we have to face is the exclusivity clauses from our supermarkets, our big supermarkets at this point in time. I think the landlords are kind of caught in the middle in this situation because we got contractual obligations you have to comply with, while at the same time we are not in favour of the exclusivity clauses. Therefore, we're quite happy to see that SAPOA is going to take the matter now to the Competition Commission for ruling. Then, just to end off, our focus for the next financial year will be to successfully open and complete Rosebank Mall and West Hills in Accra. We're continuously looking at opportunities for further extensions in our portfolio as well as refurbishments that we need to do at some of our existing centres. We've got quite a heavy workload in terms of renewals facing us this next financial year. But as I said earlier, it does also provide us with some opportunities to improve our tenant mix. We will be looking to dispose some of our non-core properties, and we are active in the market sourcing buyers for those properties. And then we'll continually looking for new investment opportunities where we can find. We've got the size of our balance sheet, we've got the gearing capacity to acquire more assets, not only in South Africa but also in the rest of Africa. Our distribution forecast for the next financial year, it is quite I think a positive one, and that forecast is at 10 to 12% for the next financial year. That's all that I have from my side. Thank you very much. We can now go to questions and answers.
Online shopping competition where traders don't open up a shop with you, they just trade online. I saw this morning that apparently the next group from England is coming to trade here, but they're not opening up a shop.
Yeah, it is something we look at all the time. In South Africa, the impact is very small. I think it's not even 1% of our total retail sales. I think also in South Africa, there are constraints for online shopping in terms of connectivity and availability issues with delivery of their products. I think even if we look at internationally, what's happened is no retailer can only do online shopping, and most of them use a combination of online and bricks and mortar, because I think that the customer still wants to have the experience of coming to a shop and have the shopping experience there. It also, pure online shopping creates some constraints for retailers as well in terms of delivery of goods and so on. So we don't see it as a big threat to our industry. I think even internationally, online shopping is actually starting to slow down a bit, where we had some higher growth in the past. But as I say, at this point in time, I think it's not even 1% of our total sales. It probably will go up to 2 or 3%. But even at those levels, we don't see it as a threat to the malls.
The offshore dollar debt, is that totally hedged? And what is the term of the hedge?
The offshore dollar funding that we've raised to acquire our interest in Atterbury Africa is currently 100% hedged. And the tenor of the hedge at this stage is only until the expiry of the relevant facilities. We haven't hedged that funding beyond the facilities, and the facilities are between 3 and 5 years. The funding to acquire the investment in Africa Land has 2 parts. There's our funding to acquire our interest in the company, and then there's funding at the Manda Hill level. The funding at the Manda Hill level is currently US denominated funding, and it's unhedged. The intention is to hedge it from probably September next month, once we finalize the restructure. We left it unhedged intentionally, pending the restructure and the merger with Atterbury Africa. The funding for our investment in African Land is currently rand denominated and will switch out into dollar funding again from September, and that will be 100% hedged for 5 years. And we're probably getting, on a 5-year fix in dollar terms, we're probably getting about an all-in rate at about 4.6%.
I just want to ask, the change in the tax treaty between South Africa and Mauritius, is that going to have an impact on Hyprop Mauritius?
Kevin, you want to answer that one?
Well,
you want to do that?
At this stage, the information and the advice that we have is that there's not going to be an impact. Hyprop Mauritius is fairly tax efficient. It's what's called a GPC1 company, Global Business License 1, and it effectively pays 3% tax in Mauritius, and then 100% of the income comes to Hyprop in South Africa, and we declare it all out to our unit holders. So we are unfortunately faced with a small element of double tax for our unit holders on that income, because what we declare out to our unit holders is taxed at full marginal rates in South Africa, but we've already paid 3% tax in Mauritius.
Yeah, so at this point in time, the tax structure still works for us, and we haven't had any issues with that. Mike?
Yeah, Peter, those properties you're holding for sale, I mean, it's quite a big number, 1.7 billion. Obviously, that would create quite a bit of liquidity if you could sell those. I mean, what are the prospects there? I mean, those 3 shopping centres, you didn't say too much about them, but 1 or 2 of them have been quite problematic. I mean, do you think you can sell these and realise the money that you're looking for them?
Yeah, I think it's going to take some time to sell them. We're not looking to sell them all immediately. 2 of them are in Cape Town, and in Cape Town they are quite a strong market. You got some local buyers as well, so we've got some good, strong local interest in Cape Town for those 2 assets we're looking to sell. I think probably the most difficult one at this point in time is the office portfolio because of vacancies, lease profiles. Office tenants don't want to commit to long leases. So I think that one most likely will take some time before we can sell that one. But I think the value centres at a certain level in the market, there is appetite for it.
I just want to, if you go on to slide number 4, which summarizes analysis of developments, etc. I did some quick math, and if you look, for example, Rosebank Mall, West Hill, and Akiomota Mall,
Yes.
the cost per square meter from Rosebank is like 15,000. If you look at West Hill, it's 35, which was close to the valuation. And if you look at Akimoto, it's 42. When you look at the yield, it looks like Africa is giving a better yield of 9.6, 9.65. But when you look at these numbers, is there some analysis that give a sense of the exchange rate or translation risk so that you're able to compare apples for apples?
Yeah, Rosebank was a unique development. It wasn't a new build. It was a refurbishment and an add-on. So even though we say it was 932 million for 62,000 square meters, not all the 62,000 was new build. Was new build. I think the addition there was, Nicole, was about 20, wasn't it? Yeah, about 20,000. The rest was existing. So it's not a like-for-like comparison. The costs in Africa are higher. I mean, Kevin can talk to it. Development costs, it does cost more to develop. But you can also see the returns we're getting there are dollar returns, which are better. And the way we structured, that's for the reason why we structured also our company structure that we're working for Mauritius, that we raise dollar debt to pay for dollar projects. And we match dollar interest with dollar income, so that the net effect of taking currency risk on us in South Africa is limited, or we try to limit it as far as possible. Does that answer your question? You want to?
So your leases are in dollars?
Sorry, say again?
Are your leases in dollars?
The leases, yes.
In Sub-Saharan Africa?
Yeah, so we're getting dollar income or dollar-linked income. And therefore also the yields that we express there is those yields are in dollars.
So is your South Africa strategy, how are you adjusting it in terms of your Sub-Saharan Africa strategy? I'm just saying the way you've done business here is obviously good and you've been successful. You are now kind of like moving into interesting higher risk area. What is the difference in strategy or approach, if there is one? Thanks.
No, it's pretty much the same. In terms of looking at what is the underlying asset or product is the same. We will only invest in quality, sizable shopping centres. Same goes for South Africa and the rest of Africa. Rest of Africa, those shopping centres tends to be a bit smaller because you don't have the same number of retailers that you can put in those centres, but they're still big enough to dominate their market and to be large enough that they can control the markets in those countries. But and I think that's probably why he said it comes at slightly higher yields. But for us, it's mainly we stick to the same strategy, and that's only to invest in large shopping centres. Okay, then that's the end. Thank you very much. Thanks for attending. And as I say, we're still around for further discussions. Thank you very much. Enjoy the rest of your day.